Time for Overlooked Stocks, and joining me now is George Tsilis, Senior Markets Correspondent for the Schwab Network. And George, it's hard to believe that a company the size of Dana, in the context of how many people it employs, almost 42,000, can be overlooked. But nonetheless, it is.
It is. In fact, you stole my thunder there, Alex. I was going to talk about the size of the company, and if you look at the company itself, I mean, first off, Dana is actually a company that's been around for quite a long time. Around 1904 is when they're founded, and they're essentially a equipment manufacturer that focuses on primarily commercial vehicles and off-highway vehicles, and that includes like construction and mining equipment. But their technologies and their mechanical goods are like axles and transmissions and drivetrain components, and they also have a power tech division which serves light medium duty trucks and light duty vehicles like Jeeps, for instance, that are sold by Stellantis. And the company, if you look at the stock price, I mean, first off, too, the stock is down about 19% over the last year. And over the last 3 years, the name has actually struggled quite a bit, with the stock down about 50%. But, a lot of things are going on in this particular space, in the automotive and, of course, the equipment space from a machinery standpoint. But if you look at the price action, the stock on the 25th of the month did gap to the downside, and you're actually seeing a pretty significant reversal. So there was a catalyst today associated with an upgrade. Barclays upgraded the stock to an overweight from an equal weight, and they moved their target from $12 to $18. And if you go back just a little while ago and look at their earnings call, and of course their figures, the company denoted sales were down 7.2%. And if you look at the earnings carefully, the earnings per share for the quarter was 3 cents per share versus 7 cents estimate, and that was down from 13 cents of the same quarter last year. And if you break down some of the divisional weakness, one of the segments that was relatively weak was their full frame light truck segment, which demonstrated weakness of about 3%, but also their electric vehicle segment was down quite a bit. But overall, their commercial vehicles are relatively balanced, but not enough to, of course, offset the decline in sales. And the other thing the company is denoting, they're going to reaffirm their fiscal year guidance for revenues, but at the same time, the company is also guiding higher for cost expenditure reduction. In other words, they're looking to save about $200 million through 25 into 2026. And this is meaningful because if you actually just look at the earnings per share produced for the quarter, it was 3 cents. But for the full fiscal year of 2024, the company is expected to earn around 83 cents, and next year $1.14. So just looking at the comparisons year over year in percentage terms for earnings, their earnings growth is estimated to be about 37%. But that's not coming from the back of higher sales. In fact, sales are expected to be just slightly higher by 0.2%. So it looks like to me this was a throw the baby out with the bathwater kind of quarter. In other words, just toss the kitchen sink out there, get it over with, and essentially what we're seeing is a potential reversal with earnings per share estimates expected to increase. And if you look at the $200 million cost savings relative to the market cap of $1.5 billion, that's a large chunk of change for a company that lost $17 million last year. On a net income basis, which is expected to continue to grow its earnings per share by, like I said, 37% between the end of this year and next year.
Yeah, it's ultimately kind of just back to where it was before that sell-off around earnings, but somehow has a completely different kind of trend and momentum to it than it did. At that point, It was downtrending and plunges. Now it's recovering, and it's seemingly accelerating in its recovery. You mentioned the 25th of November announced several things: the hiring of a new CEO, a $200 million cost reduction plan, the offloading of its off-highway business, and other things like backing its fiscal year 2024 revenue guidance. George, you look at this chart, you see that news come out, you see this acceleration, you see analysts buying in. You never know for sure, but it kind of looks like given that this is a lesser traded vehicle, maybe some fund or big investors accumulated a position over the last few weeks.
So that's quite possible. And here's the thing. You bring up some great points. So obviously, the gap lower on earnings is troublesome, and then a quick reversal, by the way. Last week was a relatively light week in terms of, people who were paying attention, a lot of folks off vacation. The other thing is valuation. And what it takes is a value proposition to unlock that value. Spinning off the off-highway division is accretive to the balance sheet because the balance sheet holds about $2.9 billion in debt relative to about $1.5 billion in equity. So that'll help facilitate some of that issue. The other thing is cost savings, $200 million, a change of executives in the executive suite. That can also shake things up a little bit. So, I'll point out here, but if you just look at the valuation for this year, it's trading at 12 times earnings. Next year, 8.5, and for 2026, it's 7 times earnings, with earnings growth expected to resume pretty significantly between this year and next, with sales not necessarily improving. So this is essentially a cost-cutting valuation proposition spinoff, and of course, sort of a reorganization of their capital. And that's all it takes for an upgrade from a company like Barclays, but also to catch a lot of interest from institutional investors.
George Tsilis, really appreciate it. As always, overlooked stock Dana, that which employs almost 42,000 people. But it's on our radar now. Big move over the last few weeks. George Tsilis, appreciate it as always.
Yeah.
We'll take a short break.